We're going to build on Wee Soon's initial topic, the growing business of identity. Our chair will be our moderator, Jane Fu. We also have Phil Cotter, who is the MD of Risk at Refinitiv. Wayne Jonson is CEO of Encompass. Stephen Ufford is CEO and co-founder of Trulioo. And Douglas Wolfson is the Director of Market Planning at LexisNexis Risk Solutions. Ladies and gentlemen.
Thank you, Mark. So welcome, panelists. Perhaps I'll just give you a little time to have some self-introduction, and then we can start with the panel discussion. It's going to be, I think, an area that, everyone here will be very interested, because it is an area, like I said in my opening speech, that it is an area of growth for information providers. All right, so we start with you, Phil. Self-introduction.
Yeah, thank you, Jane. So hi, everybody. I'm Phil Cotter. I've been working in the information industry for about 25 years. I started when I was 5 years old, by the way, just so you know. I worked for quite some period of time for Experian, running their credit bureau operations in the UK. More recently, I've become the managing director of Refinitiv's risk business, where our focus today is largely on helping customers comply with financial crime regulation.
Hi. Thank you. Thanks, Jane. I'm Wayne Jonson. I'm the CEO of Encompass Corporation. We have a Know Your Customer automation platform. I quite like Weeson's example of that. Our platform brings together data from many different suppliers. Many of you are here, are our partners, and we deliver it to financial institutions, to a range of financial services companies, to lawyers and others, for the purposes of undertaking their KYC process, primarily for corporate institutional customers, but also for individuals as well. So that's what our product does. We're based in the UK. I spend my time halfway between the UK and Australia, where I live. And before Encompass Corporation, I've spent a lot of time in the technology industry and integrating data for other purposes as well, for business processes. So it's been quite a history for us.
Good morning, I'm Steve Ufford. I'm a Canadian representing a company that I founded called Trulioo. We are based in Vancouver, BC. Currently, we focus on digital identity verification. So we cover about 5 billion people on the planet now, and roughly about 250 million companies with electronic identity verification. We primarily service fintech. The company is about 7 years old and recently have got into the banking space, and actually just launched a big partnership with Refinitiv down the couch there, aimed at automating digital identity verification for financial institutions.
Thank you.
Great. I'm Doug Wolfson, originally from the US, but based in Hong Kong now for 13 years. I actually spent the first 16 years of my career in banking in various risk and relationship management roles, so have firsthand experience of dealing with identity, and I think a lot of the issues that Wee Soon raised in his keynote speech. Additionally, I've spent time at a cybersecurity startup trying to sell cybersecurity, and now I'm responsible for our commercial strategy at LexisNexis Risk Solutions in Asia Pacific, and the focus is really on AML, KYC, additionally fraud and credit risk as well, and how we can take the physical attributes of individuals and meld them with the digital attributes of individuals and provide markets with a holistic view on their customers' identities.
Thank you. Okay, Wee Soon in his opening speech, he mentioned about the developing and building of common KYC utilities, and this is one area FIs actually look forward to. In some jurisdictions, they have successfully done that for individuals. So we can actually go to the common KYC utility and do our customer due diligence for individuals. However, when attempt was made to develop KYC utility for corporates, it was definitely a lot more challenging, and there was limited success. In fact, we haven't seen it coming yet. So as information service providers, how would you assess the capability of the information industry in building and developing common KYC utilities to service the FI's CDD requirements? We are using this term because we are also educating you on what these terms, because it is common terminology in the financial industry. CDD is customer due diligence requirements for corporates, customers, which when you do CDD for corporates, you would also have to identify the beneficial owners, who these beneficial owners are, those who are given mandate to operate the accounts, power of attorneys or mandates, and persons with executive authority, those who have authority over the account operation. So you need to also identify the corporates as well as the BOs, the beneficial owners, the POAs, and persons with executive authority. This can be a mammoth effort, but the potential returns on the effort and investment can be huge. So let's start with you, Phil.
Okay.
What do you think?
Thank you.
How do you assess the capability?
Well, I can speak with some degree of experience, having launched what I think was the first KYC utility globally in South Africa, having participated in the KYC proof of concept in Singapore. I think it's a challenge that's shared between the financial industry and the information industry, frankly. We soon alluded to the complex regulations, the fact that there really is no standardized policy approach across the globe, from banks to KYC. But it's also very complex, okay? I mean, unwrapping the UBO of an entity, particularly if it's a very complex entity, takes time and can be costly. I think the information industry is very well equipped to aggregate information, particularly from public data sources. Collection of private documentation is quite difficult from the banks, so getting the director's identity, private company documents that are often required by the banks can be a challenge. But then laying on top of all of that, I think, is the whole issue of mass adoption. Because whilst there are a lot of incentives for us as an industry and for the banks to create KYC utilities, there's little incentives for corporates today unless they know that all of the banks that they deal with are going to be able to accept the KYC record that's been created for them. And so I think the challenge is more really about how do we ensure that corporates, the buy side, counterparties have an incentive? How do they gain confidence that if they submit their information so that their KYC record can be created once, that it's then going to be reusable across all of the banks, and that they're not going to be asked to provide further information or provide all the information that they previously provided to those to that utility. So I think it's a very complex solution. I think at some point in the future it will be resolved, but I think today there are a lot of complexities that mean it's quite difficult to establish a KYC utility. And it's quite difficult to, even when it is established, it is really quite challenging to then realize the benefits from doing so.
Okay, so it sounds like it's challenging. What about you, Doug? What do you think?
We see a lot of the same issues. And additionally, from the banking side, there are banks that see their CDD KYC process as a competitive advantage. And so to give up that competitive advantage by working as part of a utility becomes difficult for them because they've then give up that competitive advantage completely. If they have the ability to source that documentation, which at times can be quite difficult and onerous. I was part of a situation once where we asked for the utility bill of a 5-year-old and a 7-year-old, which is obviously adds no value to the process. But as in general, that process, if it's seen as a competitive advantage within a bank, they're not going to want to give it up to the broader market. Additionally, often utilities will come with the implicit or explicit endorsement of the regulator, but if the regulator is not driving it, saying you must do this, you must do this, you must do this, the financial institutions in the market won't necessarily push to be a part of that as well for many reasons.
I think for the financial industry, and as a compliance professional of almost 2 decades, there is a lot of incentive for us to want to have this common utility because it will reduce cost for the financial industry. There is a lot of motivation to do it, but the cost of setting up that utility has to be probably taken account of. So what do you think, Stephen? Do you think, is something in the horizon that we can really work towards as an industry?
Well, I think we can use fintech as an example for the broader financial institutions out there, especially the global ones that faced a lot of challenges around multi-jurisdictional digital onboarding, especially of legal entities. When we look at that kind of balance between cost-saving incentive versus new customer incentive, I think what fintech has done is taken a very different, some would say, a risky approach. I think it's a more balanced approach, and the reason we see both on the retail banking side and now I think with more and more startups focused on the commercial side around a much faster adoption, millions of new customers a year or even a quarter in some cases, as Ray was saying, very focused on that onboarding experience as a differentiator. And so there are some very promising utilities in place. Now, whether they are standard utilities, that is a different question. An example would be in the fintech space, whether you're onboarding these days at an Amazon as a merchant or as a payment processor at Stripe or for a bank account at a challenger bank, that experience is mostly digital now and is very similar across different jurisdictions because a lot of these fintechs are global in nature out of the gate or go global very quickly. And so not seeking to regionalize that experience, we can look at those examples and say, well, what are those fintechs doing in terms of using at least a common approach? Because I think a standard utility starts with best practice.
Yep.
And as the compliance professionals, we understand that best practice is often hard. It's a bit of a cold start problem. No one wants to be the first one to do anything, but once it becomes best practice, everyone's very happy to do that. And I think the combination of looking at maybe what a traditional financial institution would view as a risky onboarding flow, maybe in a sandbox environment, in conjunction with a regulator watching it closely. I think there are some seedlings starting to sprout around first that standard practice being very evident and it's out there in the wild. We can all experience it as consumers today. And then tomorrow maybe some type of consortium view on what a best practice is, followed by some regulatory tailwinds. I think those 3 things, there are very early signs of that starting to happen.
Okay. Now, just to also add in a little bit of perspective in what's required in CDD and KYC, often the requirement, besides identifying the corporate, which you can actually get from government sources, right, on company registries, the requirement often is really to do the CDD KYC, drilling it down to the 2-legged persons. So like the BOs, the UBOs, or the POAs. So in my mind, is if you are able to have a common utility built for individuals, that can actually be, the experience of building that utility can actually be taken and learned and used for building the common KYC utility for corporates.
Right.
What do you think, Wayne? Because I'm really trying to get all of you thinking, because this is definitely an area of possibility and an area that can materialize for the industry and for the financial users, the financial industry users. So what do you think, Wayne?
I think there is a big divide between the process of onboarding an individual or an SME and a corporate. And if you look at the amount of time it takes to do a CDD process for a corporate, even a relatively simple corporate, establishing complete ownership of that corporate, particularly if there's holdings in many different jurisdictions, is very time consuming. In fact, it could be probably 80 to 85% of the total time, whereas it's not the case with an individual. So individual utilities are probably going to be driven by the empowerment of the individual to have access to their profile and enable that for those institutions they want to do business with. So a distributed ledger is ideal for that kind of approach. And I think you'll see more of that in that section of the market. Phil and I have worked together on a couple of these utilities for corporates. And at the other end of the scale, you have a situation, as Doug said, where the process varies from bank to bank. They see some of their onboarding processes being competitive, but they also have very different risk profiles. So part of the process is not just identifying who they're doing business with, but they will adjust their filters of Phil's products and other people's products to be able to screen according to their set of rules. So, and when you screen identify false positives, then the issue is how you resolve those. And commonising that is not an easy thing, and it's not something that I think is going to be effective as a utility. However, a utility that can deliver to the institution a clear view with all the associated documentation of the utility structure, identifying persons of control and locations, does have a lot more appeal and probably solves the bigger part of the problem. And I think a lot of it comes to the ambition that the utility wants to deliver to the bank and potentially and to its customers, and potentially that ambition has been perhaps too high in the past, which has led to the lack of success that we've seen in certain parts, in certain jurisdictions around the world. That hasn't deterred the utilities and those behind them to wanting to start again. And we've seen in some jurisdictions we're now onto the second or third generation of the thinking behind how they can deliver utility. And the reason for that is because there is significant cost savings to be achieved.
Yes.
There is a driver behind it. It just has to potentially have a more moderated view of its of what it delivers to its customer base and how it's going to deliver it.
All right, thank you. Well, at least there's some hope.
I think there is hope, yeah.
Yeah. So we soon also mentioned that information providers could look at enhancing their upstream activities. He alluded to the oil industry, data being the new oil, especially in providing the type of new and reasonable sources of information that it can collect to aid FIs perform their compliance obligations. Question to all of you: what possible upstream activities do you think information providers can explore and provide to FIs? Some examples I can think of are, like we all mentioned, the identification of BOs. That's something that will definitely be helpful, to be able to identify who the BOs are, especially in complex company structures. KYC information on the BOs and reliable information on the customers and the UBO's source of wealth, which is, an area that has been painful for the financial industry and for compliance people like us to identify, and also to, get the documentation on source of wealth, because we have to corroborate the source of wealth declarations provided by the customers. We just cannot just rely on the declarations. We have to go and look in the public domain to corroborate the information that they declare. So what possible upstream activities do you think,
So maybe I could pick that up. Yeah. So one of the things that we do at Refinitiv, along with Doug and LexisNexis, is we provide screening data for banks. And, I think the industry over the years has expanded the information that's available. UBO screening, for instance, vessel screening for trade-based money laundering, etc. I think one of the challenges for us, however, is privacy and the issue of consent. So, for instance, when we build our screening database, it's based on open source data. So that'll be government lists, sanctioned lists, adverse media, and research that we can do based on open sources. And there are very strict guidelines as to what information can be included in that database. I think, privacy means that without consent, it's very difficult for us to go much further. For instance, I don't see at any time soon we would be able to go out and, pull information from social media networks to integrate into our databases, because I think we would fall foul of the GDPR and other such regulations. And as you know, there are now quite significant fines for breaches of privacy regulation. I think in terms of, again, complex areas like source of wealth, we have a solution for that. We provide enhanced due diligence services to a number of private banks to help them with that process. But it is quite manual. It does involve you interacting with the customer, and again, using open source data to be able to verify that. And sometimes, of course, it means that the information isn't necessarily available online, so you may need people in the jurisdiction to go to the registries or the courts, et cetera, to collect that data. So I think we're working hard with the industry to try to provide more data sources that are available in the public domain. But I think there are also some limits to exactly what we can do at the moment, largely because of the privacy regulation.
I think to add to that as well, we and Refinitiv, I don't think would have any interest in pulling from social media as well, because they're not trusted sources of news. The New York Times, the Bangkok Post, these are trusted sources of news that we both pull information out of. But to go to Neil Monroe's Facebook page and see who he's talking about in this day and age, we don't know what his agenda is. We don't know where he got his information. Obviously, we can't use that. But where we do start to see value, where we've started to really see value, is in the digital space. And when we start to look at people's online interactions, and the area in that we work, and everybody here really works, is in fraud and financial crime exemptions. And there is a lot of consent there, but those exemptions are essential, because if we start to see online activity, digital activity that is outside the realm of normal, then you can flag that to financial institutions. You can flag that to other actors, regulators. We don't file SARs. Nobody up here would file SARs or STRs, but their clients and our clients would file those SARs and STRs based on the information that we're providing them. And so we're all trying to move with the times. We don't want to be in that space where it becomes static, because that's of no value to anybody. So as we start to see more in the digital space, mobile apps being the biggest part of this, but also online banking and everything else, as we start to see strange movement, we talked about transaction monitoring, and as you start to see activity that doesn't make sense, you can start to flag that more easily, because you're seeing it digitally, because you're seeing those individuals doing that themselves, and you can flag risk that 5 years ago we probably wouldn't have known existed.
Some of the source of wealth is an interesting one. It's both at the onboarding stage, but often as a result of a transaction monitoring alert. And some of the primary sources are inheritance, sale of property, sale of business. And they're things which, in an ideal world, you should be able to reference without having to spend too much time with the customer. But it's very jurisdictional. It's very country-based. It's very hard in some countries to determine property searches via individual's name or via companies' names. In some countries, it is possible. So I think there is never one solution fits all, but there is the potential to tailor solutions depending on the jurisdiction and the home jurisdiction of the customer you're dealing with, to be able to provide some information in near real time. And that then comes down to, our business is about selecting data based on what the customer requires. We are not in the business of selling data. We simply work with the sources they currently use. So we're directed specifically by where they currently go to find the information. And often that's in a very manual process. How we automate that to make that a more effective process is really a way to be able to provide a better and more effective onboarding process. So these key elements, being able to determine if someone has been involved in the sale of a business, they're things we should be able to determine, and they're potential ways for us to be able to create information at the information source to provide that information that can be used to make the process simpler and more effective for institutions.
Yeah, just to perhaps maybe tickle, your minds a bit also in terms of being able to assist financial institutions in this area in corroborating the information on source of wealth. The corroboration need not be exact. Say, for example, let's say the customers declare that he has, $5 million of wealth. The corroboration could be, estimation, for example, like if you look at LinkedIn, what profession is he in? You look at Fortune 500, any information in the public domain, like what Stephen said, anything online about that person, that can be pulled in. And then from that, you can provide some, in a way, like an estimation that, yeah, his declaration is quite reliable in that sense. So the banks then can rely on that corroboration information, and then we can close the KYC. That's done. I'm not, whether that's possible for information providers like you to help, to assist.
Yeah, so I think, let me just pick that up, Jen, because it's a good point. So I think one of the big trends in the information industry today, in an attempt to address these kind of issues, is a move towards becoming open platform providers. Yep. Okay. Mm-hmm. We soon talked about the importance of APIs. I fully agree with him. I mean, the move to an API economy that allows you to more easily integrate data into your customers' workflows is very important. And of course, that does allow organizations to begin to create linkages to data sets that could be valuable in that process, be it LinkedIn, be it property data where it's available. As long as the institution can effectively pass through the customer's consent to be able to go and get that data, mm-hmm. I think that the industry can design solutions that would enable them to go off and find that data for them. And, as Wayne said, that will vary from country to country dependent on the source of data that's available. But I think we are seeing a move towards that. I think all of the information providers here are probably investing in some way or another in that kind of capability longer term. I know certainly that Steve is doing that in his business. Yep. So I think the general trend's there. I think it's going to take us, it'll take a number of years for us to build out all of the data sets that are going to be required, and that'll be from working very closely with our partners. But I think we are trying to take a much more open approach. I don't think we need to own necessarily all the data these days to be able to connect data and provide it to our customers.
All right.
I think, Jane, just to add to that, I think in the U.S. and in parts of Europe, I think exactly that already exists, a way to go into a system and see what are a person's assets, where does the wealth seem to be coming from? Do they own houses, cars, boats? Mm-hmm. That information is significantly more difficult to aggregate here in APAC, just because of access and ability to get to it and then collate it. And we talked a bit earlier about structured data and unstructured data, and a lot of that in APAC is still unstructured, and so it makes it more difficult to connect to. But I think, as Phil said, I think everybody up here and quite frankly everybody in the information industry is looking at how can we get to that data, how can we structure that data, and how can we provide it to clients in a more usable fashion for exactly the types of questions you're asking. I think, however, sort of crawling the web for information about people becomes a bit of a slippery slope, because if you end up on Neil's Facebook page and he says, oh, so-and-so's a crook, and you crawl that information and you pull that in, that's not reliable information. So I think we have to be very discerning. Phil and Refinitiv will have an editorial review board about what goes in, what doesn't go into their database. We have the same thing. Mm-hmm. You have to be very discerning about the type of information you're willing to accept and publish.
Thank you. Okay, we move on now to the next question on downstream activities. We soon mentioned downstream activities. data and information that is used for a particular purpose can be extrapolated and extended to access other areas. So some example of downstream activities is to use credit bureau checks as part of employee background checks for AML. As you know, in all jurisdictions, the AML requirements is also to conduct CDD on your employees. So each time we hire a new employee, we have to conduct due diligence checks on them. So what possible downstream activities do you think information providers like all of you here will be able to provide to FIs? Maybe starting with you, Steve.
Yeah, I think that's right up my alley. So I would couple that question kind of on the tail of the last one, which is if you let consent drive your process for employees, which is very important also, you may have to do CDD, but then like in Canada, our employees are very protected federally in terms of the kind of information they have to provide. And then it's a much easier bar to reach from a CDD perspective if they want to provide it versus have to provide it. So figuring out that consent mechanism actually, downstream, figuring that out upstream, downstream means that much more data is available. As an example, in Canada, we have a very high population of new immigrants, right? So it's growing faster than ever before. And so as an employer of many new immigrants, the reality is, while credit bureaus are useful for me, having been born there, for folks new to Canada, that's actually not possible. So one of the things we do during that process is we ask the employee to, through an electronic means, to consent to accessing other, maybe their bank account information, maybe increasingly mobile carriers in Canada, like other parts of the world, do a face-to-face check with that employee. There's a lot of other additional information that with consent of the employee, you can access.
Yes.
Now, the regulation from a CDD perspective requires those sources to be reliable, individual, essentially non-aggregated, first party. So another example would be the utility provider. Maybe they've lived in that home for 6 months. So there's all these kind of examples that fit the regulatory requirement of data, but previously were not available because of the consent mechanism was never there technically. So for an employee that onboards, we can do that now electronically and gather and make all of these kind of eligible data sources available to them and accept any of them that they are comfortable sharing. And then through kind of meeting the privacy requirements around consent, we then can in turn meet the CDD requirements for an employee. And I would also interject that if you can do that for an employee, you should be able to do that for a customer that's a consumer, and then eventually a legal entity. Because if consent drives more access to data and you build the right digital mechanism for that, it's amazing what it can open up in terms of new kinds of data that are previously unavailable to a data aggregator that may have to rely on some underlying T's and C's based consent that the consumer was not originally involved in. I think privacy regulation in some ways is really helping the overall industry to open up new kinds of data that without that type of consent-driven access would never allow access to my bank account data for an employer.
Yeah.
But the bank is not willing to step between me and my employer to say, no, you can't do that as long as I authorize it. So that kind of interplay is really important, I think, to scaling a CDD program for, say, a large employer that may hit many jurisdictions, making sure that you build the tools, the utilities, in a consent-driven way will actually have really surprising downstream effect in terms of data access.
What about you, Wayne? What do you think? Any other possible downstream activities?
It's interesting how an institution will collect a large amount of data on a customer and only use it for one purpose, and then not use it in other parts of the business, which would actually be more helpful for the consumer. So it's a bit like, I wonder, you can lead a horse to water, can you make it drink? We provide the information to them, how effectively do they use it, and how effectively do they centralize it for its use? And so the concept of a digital profile, whether it be for an individual or for a corporate inside a bank, I think is yet to evolve in many of the institutions we deal with. And once it does, then it'll probably make everyone's life a little easier. In that even during the process of transaction monitoring, the triage, the first stage, having identified alert, is to find out all we need to know about the particular parties involved. In some banks, that's still a significant exercise to gather that information to make that decision. So a lot of it comes down to how effectively the organisations there are at using what is already supplied to them before they get even more, in my opinion. But that's perhaps a cynical view, but we see that from many instances.
Okay, I will move on now to the other two areas that we soon mentioned that, sometimes haunt us in the financial industry. That's the challenges that we face in screening the names of the customers and also in transaction monitoring. Huge volumes of alerts that come out, and very often we are bogged down by backlogs, and then it becomes, a regulator issue or an audit issue because we cannot have backlogs. Right? So a screening of customers' names, and it has to be done at each fund transfer transaction, and also on a periodic basis. We often have to do it on a weekly or on a monthly or quarterly basis. Now, sometimes the names are thrown up over and over again. So how do you think, information providers can assist to address the issue of high volume of alerts generated and the risk of backlogs not being disposed of on time?
So I think,
Doug? Yep.
you go first.
Sure. I think we'll probably have the same answer.
Yeah.
To us, and I'm sure to these guys here, the answer is better and more efficient use of technology. There's no question, when I was in banking, I was a relationship manager. I had a client once who had a very common name. It was something like John Smith. He was English, which only made it worse in finding matches. And I was handed a stack of papers this thick of John Smiths who were potential criminals. We have thankfully moved past a lot of that, and it's through a lot of companies who see this issue, who see the false positive issue, which is really the scourge of the screening industry, and are designing solutions, AI solutions, machine learning solutions, but even simple solutions like accept lists. If this person with this account number comes up again against these previously screened names, ignore it.
Ignore it, yeah.
That's a very simple solution that the periodic screening reduces a lot of that extra work that comes from it. And then when you start to have machine learning algorithms that look at the way that you have rejected something as a true positive, made it a false positive, and applies that logic in the future, as long as you're monitoring what that algorithm is doing and testing it and auditing it from time to time, this can also massively reduce the amount of false positives that you're finding in your portfolio, and quite frankly, a lot of wasted man hours that go into it. And so we see it, and we work with a number of partners, as I'm sure you guys do, as technology is going to be the solution. Better technology, more efficient technology that helps reduce a lot of those negative symptoms from the screening.
And I want to tie this in with transaction monitoring as well, because, like one of my previous organizations, we hired like 200, analysts just to be able to review all these suspicious transaction alerts and to dispose of them. And, the resources is really just phenomenal. So how do you think, information providers can also assist FIs in addressing this perennial issue of high volume of alerts generated with low conversion yields? That means most of the alerts generated are in fact not suspicious. So it's linked in. How do we perhaps use machine learning? Maybe Stephen or Phil here can talk about it.
Well, let me just kind of build on what Doug was saying. So I think both in screening and transaction monitoring, using technology, and I'll come to AI in transaction monitoring in a minute. But there's also a data element, obviously. I mean, as providers, if we can find secondary identifiers, so if you can find a date of birth or somebody's been accused or committed financial crime, which doesn't always, appear in the article and things like that, then that will help. If we can find a country or nationality that you can associate with that individual, and you use that in your screening, then that hopefully will help you to reduce false positives. It is a particular challenge in this region. Multi-part names are really difficult to match. Yeah? Once you get to 4-part, 5-part, 6-part names, it's very, very difficult. We soon talked about, transliteration errors, aliases, you name it, right? It's very complex. Transaction monitoring is an interesting area, I think. So I think I can say this, he won't mind me saying it. John Cusack, some people may or may not know John. John was the global head of financial crime at Standard Bank. He's a prominent member at Wolfsburg. He's very skeptical about the use of AI in transaction monitoring, primarily because he said there is no clean data sets for anybody to train the machines on. Okay? And, to a certain extent, I think that's possibly a valid point, because, of course, so many SARs are created that, as you say, are not actually suspicious at the end of the day. But personally, I think there is a route. We partner with a company, for instance, who I think have taken a sort of pragmatic approach, which is they've created a rules-based transaction monitoring solution like everybody would be familiar with. And for instance, there are certain things you don't need AI for. You don't need AI to tell you that you can't do business with a North Korean institution, for instance, right? But I think they also allow you to apply AI over time. And I think, from my perspective, the way that we can help the banks is that sort of, how can you transition, how can you do champion challenger type programs where you can assess the effectiveness of AI against the effectiveness of current rules-based solutions and whether they drive down your false positives. But I think it is a significant issue for the industry. I think it'll be an issue that will be around for a number of years. I believe that over time, working together, we can reduce it. But it's challenging. There's no doubt about it. There are high volumes of transactions and payments that are being screened every day. By the very nature, if you're a large bank, you're going to create a lot of potential alerts, and then it's how do you curate them. I know that some companies use multi-stage processes, so you spit it out of Actimize, and then you put it into something else, and you run it through that, and then eventually you hope that you've triaged it to a point where you don't need a lot of people on it. But very complex. I do think technology has a part to play. I do think data has a part to play. But I still think there's a lot of work to be done.
I think there also needs to be a bit of a mindset change in the way that people think about transaction monitoring. A lot of the transaction monitoring is very sort of static rules set. If it's over X number of dollars, put it in a queue and investigate. If you have somebody who transacts, say, $15,000, $20,000 on a regular periodic basis, and they continue to do that, it's always over the limit. You're always going to generate a suspicious transaction. But that might not be the risk. The risk might be the person who's doing $1,000 here, $1,000 there, $1,000 here, then all of a sudden doing $8,000, $7,000, $9,000. It's lower. In U.S. dollar terms, it's below the U.S. limit, but there might be a risk there because it's outside of their normal behavior. And so starting to look at behavioral aspects and thinking about behavioral aspects rather than just static rules is sort of a mindset change also that people need to start thinking about.
Yeah.
That applies to the regulators as well, of course, because many of them are still rules-based.
Of course.
All right, so I think we have about 15 minutes left, and I'll open the discussion to the floor. I'm sure there'll be some questions coming for the panelists here. Yes, there's one over there in front.
Good morning, Ingban here from QC Global Services. Recently, the news is that the U.S. Department of Justice just claimed back over $1 billion with an alleged fraudster from Malaysia implicated in the 1MDB case. So given what we have currently in CDD, KYC, all the monitoring that is in place, what is the panel opinion that such a case could happen in the past? And do you think that the current regulations and all the monitoring that's in place will be able to capture such a billion-dollar whale?
Good
Anyone of
question.
you?
Good question.
Yep.
So the first thing I would say about large fines are that they are significant breaches of compliance. If you look at some of the historical fines, you know, this is public knowledge. So if you think about HSBC, who built tills so that the drug, launderers could fit their cash into the branch when they brought it in their duffel bags, those are egregious failures. So I think, unfortunately, there are still institutions whose AML controls are not good enough, right? And that's why we continue to see these types of fines. I think, however, for the majority of banks, I think there's a real focus now on not just compliance, but fighting financial crime. And those things are different, okay? Because ticking the boxes and being compliant doesn't necessarily stop money launderers at the end of the day. I think I see tier one banks in particular and other banks and in this region as well, moving much more towards, look, we really are intent on detecting and disrupting money launderers as best we can. But it's still a big challenge. And, financial criminals, they are inventive, and the networks they run are complex. If you look at the Russian laundromat, money was laundered through 96 countries, over 5,000 entities. Okay? It's really difficult to be able to understand that kind of network, detect it, and disrupt it at the end of the day. So this is a complex area. I think banks are getting much better, but we'll continue to see lapses, as we've seen with Danske Bank in Europe, for instance, okay? I mean, they simply did not apply the right controls at the end of the day, and that's the be-all and end-of-all. It wasn't data, wasn't technology, wasn't anything else. It's just that management did not do what they need to do to be able to ensure that they had a compliance culture.
And I think you've clearly read the book. You can see throughout the story, there are people who are raising concerns. There are parts of the system that were working, but at the end of the day, there were failures to deliver on closing accounts, stopping transactions, that the business incentive won out. And I think it's been one of the major changes. Certainly I was in banking until about 2016. I saw at the tail end of my banking career was that the importance of compliance and the importance of being compliant and not just checking boxes had completely shifted from previously, and that business people who historically only cared about sales and the next deal were all of a sudden talking about, do I need to worry about this? Do I need to worry about this client? Do I need to worry about this issue? And quite frankly, the two biggest potential risks that I saw over the course of my career were brought to me at the tail end of my career by people in the business who are now much more focused on this type of thing. And so I think there's been an attitude shift. Does that mean there won't be another billion-dollar whale? You can never guarantee anything, but I think people have reacted to that.
The process of de-risking that some of the banks undertook, right or wrong, did send a message internally that not everything goes, and customers that were to hard won were then de-risked. And I think that was a big reinforcement inside. But as you said, it has a lifetime, and potentially over time that memory will fade. So,
I think in the 1MDB case, it's clear it was the person you're referring to is J. Lo. Basically, I think the bankers were just, closing an eye to the kind of huge transactions that he was transacting, and is clearly inconsistent with his income level, his wealth profile, but they were allowed to go through. So the source of wealth was actually not clearly determined, and it was clearly a suspicious transaction, but they didn't pay attention to it.
What's really interesting about it is if you look, there's at the very beginning of the entire story, there was, I believe it was at Deutsche Bank, there was a compliance officer that raised major concerns and got a call from the Prime Minister's office. Now, wherever you're sitting in the world,
Yeah.
if you're a junior level compliance officer and you get a call from the Prime Minister, if you don't immediately think that that's suspicious, you're going to do whatever that person tells you to do. And so I think that it was a combination of some major failings of compliance programs, but also a willingness at the top levels of power to commit this fraud to, that allowed it to pass.
Okay, any other questions from the floor? Yes, that's one over there.
Hi, Matt Gamser from the SME Finance Forum. Since I want to go at the de-risking issue from another angle, because I think this panel has been really fascinating about, but maybe why we're not getting to a utility that would lower everybody's costs. My question is, may that have less to do with protecting comparative advantage of good practicing institutions and more with protecting bad practice by established large institutions that are effectively controlling certain global markets? And let me give a specific example. In IFC, we do a lot of business in trade finance around the world. And many of our client banks, initially it was about showing their correspondent banks that they weren't going to fail. But since 2008, it's been about providing a risk protection, de facto or not, of that these are going to be okay banks and you're not going to have a compliance risk in being the correspondent bank to these. But when I had my annual meeting the other day with bankers from all over the world, there were several bankers from this part of the world that described some pretty disturbing experiences in their negotiations about retaining their respondent status with respect to trade finance. And the discussion, without revealing any specific names and examples, they tended to talk about getting requests from a correspondent bank, being a Wolfsburg Group bank usually, that, well, why don't you have 150 more compliance officers? Because the way we look at it is to be compliant at your level of business, it's all about this much money means this much people. This in an age where we've just been talking about all that technology can do, and with many of these banks having gone farther into technological change than their Wolfsburg counterparts. So to what extent is this really a technological problem, and to what extent is it really an institution and standards and industry level, market level problem?
Maybe I can answer that.
Yep.
Great question, Matt. I think there are a number of potential issues here. Yeah. So, first of all, not every bank has the same risk appetite, not every bank has the same policies, and therefore, to create a KYC record that would be reusable across effectively the whole banking industry is quite a challenge, okay? In fact, it's probably nigh on impossible. The best you can do is probably create a kind of foundational record that everybody's prepared to use, but then you question whether there's any real value in that at the end of the day. So that's one point. Secondly, the banks have actually got a whole lot better at KYC in the meantime, okay? And so actually for some of them, there are benefits to going to a utility, but they're not as big as they were 5 years ago, I would contest. So that's another point. The third point that you've raised, which is about liability, is a really interesting one, because if you build a utility, then ultimately who's liable? Is it the utility or is it the bank for the effectiveness of KYC, for any potential deficiencies in KYC, and who are the regulators going to come after? And I can tell you in the conversations I've had with banks in setting up utilities, that's always been a point that never really got resolved, frankly. Never. Okay, contractually we agreed something, but we never really resolved that. I think on the point of de-risking, I was at a conference a couple of years ago in London, and a senior compliance officer from one of the banks. We had the FCA, the Fed were there, the NCA from the UK. And they talked quite openly about de-risking. They said, look, there's a senior manager's regime. I'm now personally liable for failures of AML compliance. There are respondents in jurisdictions where I know that the AML, culture, regulations, etc., is inadequate. And frankly, at the end of the day, I'm not going to take the risk associated with that any longer. Yeah, it's a real challenge because unfortunately it means that probably the very economies we want to connect to the financial system are being financially excluded at the moment. Yeah, and therefore the money is clearly going underground and moving through other methods that people can't trace, etc. So, I think it's complex. I think it will take, action from the very top. I think it needs governmental policy. It needs regulators to revisit this space to really come up with something that works for the banks, for the respondents, and for the regulators personally.
I mean, the only retort I would have to that from IFC's perspective, since our clients are mostly the emerging market banks, is that, yes, the rap from the developed world is that these guys aren't up to standard, but what we actually see in many of our markets is these banks are more advanced. Their systems talk to each other. They don't have legacy issues. And it's the lack of willingness of the Wolfsburg Group to bring its systems into the 21st century that is the real cause of much of this de-risking, as opposed to the lack of the willingness in the emerging markets of the banking sector to upgrade how they handle this compliance. And this is, and I don't see otherwise why we still have this huge business that we shouldn't have when we see all the technological improvements that many of our clients' banks have made around the world.
Yeah, I think we could have a whole conference on this particular issue, to be honest with you, but you make some good points, Matt.
I think on that particular point, first of all, I'm delighted to hear that compliance is a major issue that they bring up with the respondent banks when they're having those due diligence interviews, because historically that wasn't the case in a lot of those Wolfsburg Group banks. But I think what we found, we ran a survey this year that we had run previously in 2016, and it asked the question about technology, and we found in 2016 that 81% of compliance costs went to manpower, whereas now in 2019, and this is specific to APAC, 2019 it's about 55%. Now that's great, that's a huge leap forward, right? But it still means that over half the cost is going to manpower. So that needs to continue coming down. The systems and the connectivity does absolutely need to improve. I've seen it firsthand myself. But it seems to me from both what you're saying and from what we're seeing from that survey that it's moving in the right direction.
Okay, we are coming to the end of our panel discussion, but I would just like to throw this question to each one of you to get your view on one area which you think is a potential area that you can build on and assist the financial industry in the compliance requirements. Starting with you, Doug. What is that one area which you think is workable that we should be focusing on and working on?
So we want to be focusing in the area which the markets are focusing on, which is digital. And it's not just the banks, but it's the fintechs, it's the payment companies. It's everyone is moving to digital. And I think, Stephen, you mentioned this a bit earlier. So our view is companies that are in the digital space need to be finding efficient end-to-end STP solutions for their physical identity, monitoring their digital identity, monitoring who's connecting to their network, how people are using their products, and making sure that they can real-time monitor the risk that's in their platform, because those are the ways that we see being able to stop the next billion-dollar whale, is to monitor these things in real time.
Thank you. And Steve, what about you?
In a word, interoperability. So what we're hearing today is there's tons of new data and capabilities starting and coming around the corner. What I never see is any kind of standard, and compliance thrives on standards. And so as the world further becomes globalized, I think where technology can really help FIs is in the big I. It's extremely difficult to be a big multi-jurisdictional organization, or even a regional one now, with all this new data and information and services and vendors. And making that all work together through an end-to-end kind of compliance workflow is very difficult. And so we try and focus our bit on making all of those solutions interoperable so that you can consume it through a single endpoint and hopefully take kind of a gateway approach to compliance. I think that's really where there's or a platform approach, where there's a lot of room for technology to help.
Wayne.
I think I agree with Doug, actually, monitoring, in that the world continues to change, and as Phil said about a utility, even holding a full information packet about a customer will change over time. So what's its value next week or the week after? So we have to move to an event-based risk assessment, not just assuming that all our customers who were properly onboarded are still correct. So the process of rescreening, the process of monitoring changes to beneficial owners, and then having an effective way to determine if there is a change, is that change important, do I need to action it or not, and then making sure that base of customers remains compliant is probably the next wave. And I think that that's an area where the information industry can assist through not just the provision of information, but the provision of alerts and changes to that information, which could be consumed more effectively by those who have to manage and maintain it.
Thank you. And Phil?
Our strategy at Refinitiv is to invest in our open platform. That means investing in our own data and working with best-in-class partners to ensure that we provide accurate data, the breadth of coverage that our customers require, and then augmenting that with technology that ensures that the information is relevant to them at the particular point in the workflow and to help them improve their efficiency and effectiveness. I think much of what the information industry has been doing for years, but continuing to invest in making sure ultimately, because if data is the new oil, then you need to know that that's trusted data.
Thank you. And with that, let's thank our panelists.
Thank you.